Good morning and welcome to the investment meeting of the Teachers Retirement Board for March 30th, 2023. I'm going to call the roll. Mr. Brian Berge.
Brian Berge, representing Mayor Eric Adams, present.
Thomas Brown.
Good morning, President.
Anthony Giordano.
President, representing PEP Chair Angela Green, proud to be here. Thank you.
Allison Hirsch.
President, representing Controller Brad Landers.
David Kazansky.
Present.
Victoria Lee.
Present.
We have a quorum, Mr. Chairman.
Thank you. We'll start with the passport funds and we go to Roboton. Who's going to pick that up? Amanda? Great,
Let me just get this up on the screen here.
There we go.
All right, so for the month of February, in terms of general market results, certainly we did give a little back from the stronger rally that we saw in January to start the year. Looking down at that 1 month column here, you can see essentially slightly negative results across the board on an absolute basis. And in terms of those market results, we did see a weaker month driven by a couple of things. One of which is that we did see some of the inflation numbers for the last couple of months revised upward. We also had the Fed hike rates another 25 basis points following along their schedule. Markets by the end of February had increased their expectation of where that peak Fed rate was going to land later in 2023, up by another 50 basis points or so. All of that led to weaker market results. So 4-year diversified equity fund, which does hold the bulk of the assets in the passport funds, results for the month of February were down about 2.5%. I mean, you can see that was, pretty evenly even returns between the US and non-US equity components of that fund. The fund is still in positive territory year to date, up just about 4.8% year to date through the end of February. And the actively managed component did add about 1.6% above the benchmark, especially some of your growth oriented managers that have benefited here so far in 2023. Your balanced fund was also negative for the month of February, down about 1.9%. Although protected a little bit better than the equity option, just given that it is a more conservative allocation. And that fund as well is in positive territory year to date, about 1.3%. And in terms of the international equity fund for the month of February, down 2.8% and up about 5% year to date. In the international equity space, developed markets have fared better than emerging markets, which have been a bit more negative here so far in the year. One of your best performing funds year to date is the Sustainable Equity Fund, which was down about 1.6% for February, but was up close to 8% year to date. That fund does have a bit more of a growth tilt. So especially in January and to some extent in February as well, we saw very strong results from the tech sector, which features heavily in growth-oriented funds. And so that Sustainable Equity Fund did benefit there. And then your passive equity options are tracking their benchmarks as we would expect. The International Fund does have a bit of fair market value pricing impact in there that's causing a bit of tracking error.
Thank you. Well, appreciate it. Any questions for Amanda? Great. We move on to the March 2023 market performance, and I guess Devin. Yes. Thank you, Deb.
Just switch this over here.
So I'll be discussing the performance results as of March 20th. That's Tuesday. The benchmark report. So I guess we could say here that is consistent with March Madness. We did see a bit of we saw some tension in the banking system. We also saw some tightening credit conditions. And that led to some varying performances across the board for all major asset classes. The global market composite benchmark was down by 70 basis points, but year to date, up 3.68%. Also down was diversified equity fund hybrid benchmark, down by 0.84 basis points, but up 3.5% for the year to date. We move over to the balance fund benchmark. We did see positive results for the month and also year to date performance of 2.28%. Down to our sustainable equity fund benchmark, we did see positive performance across the board for both the month and year to date, and mixed performances for the US equity index fund benchmark, down about 88%, down by 88 basis points for the month, but up by 3.58% year to date. So the overall theme here for the month would be varied performances across the board for all major asset classes. But despite the pullback in March, in our February, we did able to maintain a positive performance year to date so far. A little better.
Thanks, Deb.
Thank you.
Thank you. Any questions for Devin? Okay, we move on to the public, let's see, the pension, the strategic asset allocation considerations and discussion. So I guess it.
I think Steve is gonna open it up, right, and then pass it up.
Yeah.
Oh, Steve is online. Oh,
Steve is online.
oh, there you are, Steve.
I'm here, guys. I apologize for not being there in person, but it's good to see everyone through Zoom this morning. Good, good, good. Thank you. Sorry?
Just said good morning.
Oh, good morning. Good morning. Well, let me kick it up. Before I turn over to Ed, I'm going to actually ask Ed Berman to take us through a presentation deck. But I just want to give you a couple of quick remarks on where we are in the process of looking at strategic asset allocation. And again, particularly following the change in legislation in the latter part of last year that opens up the basket clause for a higher allocation into those eligible assets. So first of all, we've established a timeline for this important work for 2023. Actually, Allison Hirsch took the lion's share of the responsibility for putting the timeline down, which we're adhering to. We've organized a team within the Bureau of Asset Management to spearhead the project, which includes me, certainly Petra Nikolova and Anash Kadziela, the two deputy CIOs. Also John Mercerberg, the asset class head for equities, Robert Fang, the asset class head for public fixed income, and last but not least, Chief Risk Officer Ed Berman. So we've got a team in place that are working on this proactively. We've also reached out to the plan general consultants, obviously including Rokutan Goldman Sachs, to begin collaboration, really trying to review and understand their capital market assumptions, and the way Ed puts it, to really understand the assumptions that underlie their assumptions as building blocks for a strategic asset allocation review. We've also been working with the consultants on a project plan, and internally, actually, Kate Visconti, our chief of staff, is working on that with me and others on the team to kind of put things in place so we make sure we're making steady progress. We also are planning for active engagement with trustees throughout the process, and that will be part of the project plan. As we reflected last month, it's certainly very important in terms of our focus. And the hope and plan is that we have this work completed by October. We really want to have these, any changes, and we want to pre-game this. Obviously, the decision rights are those of the trustees. But if there are changes in the allocations of private assets, we'd like to be able to incorporate those into our 2024 and beyond pacing plans for those assets. And that process really begins November, December, actually even begins in October. So if we can wrap it up by then, I think that would be in pretty good shape. Maybe just take a step back before I turn it over to Ed. In early January, I sent an email to our asset class heads, and included, of course, Chief Risk Officer Ed Berman, detailing these 10, what I thought were forward-looking themes that I believe we should incorporate into our long-term strategic asset allocation or strategic planning. Ed actually took these themes and vastly improved on them. and consolidate them into three broad themes that are much more focused in view. And I'm going to turn over to Ed now to actually take you through a presentation of those themes and how he thinks about them to form a basis of the strategic asset allocation. Again, trying to be more forward-looking. And again, Ed will talk about how we intend to do that. I should also mention that we've shared these obviously with Mike and others at Rokutan, Goldman Sachs, and all the plan general consultants. So with that, if there aren't any questions, I'm going to turn it over to Ed to kind of walk us through the presentation deck.
Great. Any questions for Steve? Thanks, Steve. Ed, welcome.
Thank you. Can we have the first page? The next page, please. Thank you. I think there's a lot of mystique around asset allocation about the approaches. So we just want to talk about what it means and the steps involved. But fundamentally, it's probably one of the most important decisions that you make. As we all know, asset allocation determines about 90% of returns for the system. And as pretty much everything in finance, asset allocation is a blend of science and art. And I would say in this case, it's more art than science. So fundamentally, there, I mean, you hear many technical terms that mean there is optimization. There's a lot of technical jargon, but fundamentally, there are three main steps in asset allocation. So first, you come up with assumptions, meaning you project the returns of asset classes forward 5 to 10 years. Step number two, you decide which assets to put in your portfolio. And step three, you apply the statistical techniques to come up with the best allocation, which gives you best returns for level of risk. Probably the most important step in this process is so-called long-term capital market assumptions. We obviously don't know the future. Like nobody knows the future. It's unpredictable. And there are many different approaches how different teams come up with the assumptions. But fundamentally, on the extremes, there are two basic approaches. So on the one extreme, people say it's all about the history. We'll look at the past trends or the past performance, and we just project it forward mechanically. Another approach to say that the history is a poor guide, and we'll just come up with the assumptions based on understanding of the economy. I think in reality, most of teams use some kind of blended approach. But no matter what we use, history is our guiding post. And what we'd like to argue now is that we always say this time is different, but maybe it truly is. And the history is not a perfect guidance for us going forward. So usually long-term capital market assumptions are based on about 20 to 25 years of history. And if you think about the past 25 years, well, obviously it was a turbulent time, both in the markets and politics and otherwise. But there are several key events that stand out in the financial history. So first of all, we started this period with the dot-com bubble. And you would say, as dramatic as it was, it's your typical run-of-the-mill market. Markets went up, markets came down. It happens every 10 to 20 years. As bad as it was, there's nothing unusual about dot-com bubble. A few years later, the global financial crisis, starting in 2007. That crisis was unusual. Now we're talking about once in 100-year events. So we need to go back to the 1920s to see something similar in scope and magnitude. These crises are unusual. They're long-lasting. On average, it takes 10 years to work out through the problems introduced by the financial crisis. And we don't know the future, but chances are for the next few decades, we will not see it again. That was followed by the European debt crisis. Again, a highly unusual event. You may say it was an extension of the global financial crisis. Highly traumatic for Europe and probably not likely to happen again in the near future. And finally, today, we have a combination of COVID, pandemic, we have inflation, we have war. We need to go back to 1918 to find a similar combination of macro factors. Again, hopefully, we will never see it again in our lifetime. But no matter what, the past 25 years may be poor guidance going forward. It may be poor guidance in sense of just mechanically projecting the returns. It's also poor guidance in terms of our opinion about the future. So think about the junior analysts in the 1990s. Now these people are in the mid-50s. These are the people in senior roles making decisions. Their opinions, just behavioral bias, are influenced by this history. So what's important for asset allocations? Can we have the next page, please? So again, the world is uncertain, the future is unknown. So we talk about multitude of themes and approaches and ideas. But fundamentally, I would say there are three building blocks that influence everything. And these blocks are the inflation, the GDP, and the uncertainty. We'll go through them in the details, but inflation is something that obviously we're living through now. It's clearly a traumatic experience. Nobody likes inflation. It's actually not that common. Inflations come and go. And if you look at the history of the world in the 20th century, 21st, it typically comes, it lasts for a year to 2 years, and inflation is usually gone, but it creates lasting impact. So we'll talk about why and what it means. The GDP growth underlies everything, right? So we talk about GDP, which is global domestic product. The flip side of it is the gross domestic income. So that's the sum of all incomes generated by the private sector, by the consumers, by the government. This is our economy, and this is income that divided between private sector, public sector, and that ultimately determines corporate profits and determines the market returns. And then the uncertainty. Yeah, we'll talk about it. The world is always uncertain, but I will argue it's now more so than ever been. And so for each of these three themes, we'll try to answer three questions. First of all is why it is important. Second, what drives it? And the third question, how do we express this theme through asset allocation? And as we'll go through this, please stop me in a moment. Much I have this discussion rather than presentation. So please stop me if there's any questions. So starting from the top, inflation. So intuitively, we all know what inflation is, right? It's just change in prices. Why inflation is bad? The truth is, most people don't notice inflation until it reaches about 5%. Just empirically, consumers are comfortable with inflation around 5%. We know that negative inflation or deflation is highly damaging for the economy. So most of the central banks adopted a policy of about 2% inflation. Again, there's no consensus around this number. Most economists would probably go to 3 to 4% inflation as well, like a better regime. That said, as bad as inflation is, what's damaging is the change in inflation. That is the uncertainty. So consumers hate it because it discourages consumers from buying consumer goods. Businesses hate it because it discourages business from investment and growing their operations. Clearly, inflation increases cost of servicing debt. So anybody who has a floating rate mortgage knows it firsthand. Anybody who has a fixed rate mortgage, probably very happy right now. Inflation is even worse for small economies, usually emerging market economies, who rely on imports, specifically food imports. So high inflation regime may create actually starvation around the world. So they feel damage. We talk about inflation being something uniform, but in reality, there are ranges of inflation. So domestically, even within our country, like in the Northeast where we are, the inflation tends to run lower than in the Southwest. It's actually materials at the peak when inflation was about 8%. In the New York State, it was close to 6%. In California, it was probably more like 10 or 11. Right, so that's also not helpful, but the situation is much worse in Europe. So for example, just today, Spain reported that inflation rate came down to 3% from 6%. It's a huge jump down. At the same time, in Estonia, one of the smaller countries, inflation runs close to 20%. Think about the European Central Bank, when they had a single rate, single policy rate to fight such a broad range of inflations. It's difficult. Easier for the Fed, difficult for the European Central Bank. The point is, it's this spread, the range of inflation that creates more problems. Inflation reduces real incomes. So we probably all read about it that the real wages are not keeping up with inflation, meaning that in real terms, workers to get less compensation. It means they get less money to spare, so there's less consumption. So there's less need to manufacture goods. And in the end, they hit a spiral when the economy is just piling down. In the extreme case, there is deflation. Think about the 1920s, 1930s. It was a highly traumatic experience. It's clearly damaging for anybody on fixed income. The pensioners come to mind. So inflation is not very helpful, but as bad as it is, it's the deflation that we really worry about. And historically, periods of high inflation were often followed by periods of deflation. Japan probably being the extreme case, they never emerged from this deflationary period. And probably one of my favorite examples, if you think about Germany in the first half of the 20th century, so common narrative is that inflation created a transition, helped the transition from Weimar Republic to the Nazis. It's actually deflation that led to the Nazi Party winning an election. So with this in mind, so what drives inflation? Can we get the next slide? So the short answer is we don't know. So there used to be a better time, simpler time, like maybe 10 years ago, when there was a dominant view on inflation. It's all about money, so-called monetarist view. And Milton Friedman was our most prominent economist who came up with this view. I think the consensus among economists right now is we just simply don't know. And put a quote here on the slide from Alva Blanchard, his former chief economist of the IMF. It's a quote from about a month ago, and I read it in full. It sounds a little complicated. So inflation is fundamentally the outcome of the distribution conflict between firms, workers, and taxpayers. It stops when the various players are forced to accept the outcome. Just think how complicated it is. How many moving parts? We don't know what drives it. We know that it's here. We know it's damaging, and we know we have limited tools to fight it. There are several ideas that we can propose that probably influence inflation led it. One of it is the role of globalization or regionalization. So the rise of China in the 21st century was probably one of the most important drivers of the environment of low inflation. And ultimately, it's a wage arbitrage. As more manufacturing shifted to China, clearly prices came down globally. We can talk about the role of the state, and it can be either through monetary policy, which is usually the role of central banks. That's in the news. Every time Powell has a press conference, we'll listen very carefully. Or it can be through the fiscal policy, and think about the almost $5 trillion stimulus that the United States injected during the COVID days. Think about the IRA Act from the current administration. The fiscal policy has probably not so well understood role in inflation, but the impact is clearly there. So I've seen estimates for the $5 trillion stimulus. Some economists say it's about half a point of inflation. Some people say all of inflation came from that. Will be a lot of PhDs written based on this for many years to come. As of right now, we just don't know. Inflation is influenced by the patterns of global consumption demand and income distribution. And income distribution is important. We all hear about income and wealth inequalities, but what it means is that more wealthy people accumulate more income, but they actually don't consume. If they don't consume, they don't buy stuff, prices come down or don't come up as much. So more income inequality means less inflation. Geopolitical conflicts obviously create a very strong influence, as we've seen with the current war between Russia and Ukraine. There's a huge concern about Taiwan, which clearly, I'm not going to be going into this, but I'm sure everybody's familiar. And last thing I want to highlight is the role of US dollar. It has a central role in the global financial system. I'll just mention it's a complicated role, but that's clearly has an impact on inflation. So how do we express inflation views in asset allocation? Can we have the next slide, please? And here I'd like to talk about two extremes, the environment of low inflation versus the environment of high inflation. Starting with the low inflation, that's the word very much familiar to us. So we're talking about 2010s and the past decades. So in an environment of low inflation, the stock bond correlation be usually negative. What it means in reality, when equity prices rally, bond prices fall. It's helpful for the portfolio construction. It helps to, that's the foundation of this standard 60-40 model, 60% of stocks, 40% of bonds, where bonds create some kind of cushion for the portfolio and helps absorb the shocks. At the same time, in a low inflation environment, interest rates tend to be low. So the role of fixed income in the portfolio is reduced. You're getting obviously less income. It's more of a quality with at least diversifier. So it helps to cushion the blow, but it's not much in terms of positive contribution from fixed income. And on the equity side, it's the growth stocks that produce the most of returns. Think about the internet stocks, think about all these venture capital stocks, and obviously the private investments, right? So the recent private equity took off after the global financial crisis. Again, the question people hotly debate, but it's probably fairly clear that the low interest environment was very helpful to the growth of private equity. On the flip side of the equation, the high inflation, the stock bonds have to be positively correlated, meaning stocks and bonds move together. We've seen it in the past years. So every time we talk about the quarterly results, we comment how both stocks and bonds sold off at the same time, and how it's unusual. That's the high inflation environment. On the positive side, now treasuries produce real returns. High yield delivers 8-9%. So we're getting real carry, real contribution from fixed income. But on the equity side, we need to change our exposures. Now it's the defensive, the value stocks that help. Growth, the internet stocks, technology will probably underperform in this environment. And finally, real assets, think infrastructure, real estate may be helpful. It's a little bit path dependent. But generally speaking, we think that real asset may help in this environment, and under some conditions, commodities may benefit. So that's inflation. So let's talk about the second theme, GDP. So here it's important to say that we're talking about the real GDP growth. It's not what usually quoted in the news, what we feel like 3-4%, the two components of GDP. It's the real and the inflation, right? So we're talking about real. That's what matters for the financial markets. It matters for everyone. This is total income produced by the economy. And simply said, rising tides lifts all boats, right? In expanding GDP, expanding economy, rather, consumers have more money. They consume more. Companies produce more. Companies invest. It's a self-perpetuating cycle. Life is good, everything helps, and nobody likes recessions. But what's important for markets is that the rate of the GDP growth influences central bank policies, right? So we have the Federal Reserve sitting on the sidelines, watching the economy to overheat. They will try to, when things getting too good, they will raise rates. When things go not too good, they will cut rates. So some of it is managed. Clearly, expanding the economy will create positive environment for equities. That's no big surprise. But the important thing to remember is that the long-term rate of the GDP growth ultimately determines the interest rates. And loosely speaking, you may think of the rate on the 10-year treasury over the long term converging to the GDP growth, right? So that's a useful yardstick. So if we expect the real GDP to grow at 2%, that will roughly be the rate on the 10-year. It kind of gives you an idea of what to expect from the returns from fixed income, but it actually influences all other parts of the puzzle. So what drives the GDP? What determines the GDP growth? And can we have the next page, please? Kate, thank you. So here we have a single equation for this presentation. It's a simple equation. And simply put, the GDP growth is just two components. It's the growth of labor and the growth of productivity. There's really nothing else to it. Let's take them in steps. Let's first focus on labor growth. So labor growth, first of all, it's about demographics, right? So we all heard about the fertility rate declining across the board. So the kind of neutral rate is 2.1 child per family. We haven't seen the rate of growth in the developed world for a very long time. Probably nowhere outside of Africa we see population growth, fertility rate at this level. We're actually doing not too bad. I think we're close to 1.8. One of the worst countries in this sense is South Korea. It's about 1 child per woman. It's like disaster. China is not doing too well, partly result of one child policy. Japan is not doing too well. Western Europe not doing too well. It's not helpful for the economy. On top of it, we have, and by way I mean most of the world really, aging demographics, so many people leaving the labor force. What helps us is labor migration. So clearly, immigration to the country will increase the supply of workers and consumers at the same time. The retirement age, it's a big question, right? So we see a lot of people re-entering labor force, either part-time or full-time. And really, it's what's happening in France right now, it's all about the retirement age, trying to move from 62 to 64, and it created a firestorm. But another important factor is the labor force participation, or loosely speaking, how many people actually participate in the labor force. And even though there's one number, I think it's about 62.4% right now, there are variations, right? So there's variations by gender, by race. And sadly, the labor force participation came down significantly during COVID, and we still haven't recovered. We're still running a few basis points below the pre-COVID labor participation, meaning less people actually willing to work or enter labor force for various reasons. So less people working will be low GDP. The other side is productivity. And the productivity, quite simply, is the amount of output produced by one worker in 1 hour of work, which is, a very blunt tool. There's no such thing as an average worker. There's no such thing as an average output. But it's not what we can measure, and we know that this number has been declining very fast. Again, we do not fully understand why productivity is so low and declining. And I think it was a very popular trading strategy starting in 2010 that it on the increase in productivity growth, it just never came to be. We know that the productivity reached its peak around mid-1940s, most likely as a result of the Second World War, and it was simply fewer workers working long hours, well, not very helpful. We know that productivity spiked during the periods of technological innovation, but it came with a strong lag. Like famously, the electrical bulb was patented in 1870 something, and the widespread of electricity only occurred about 50 years later. The invention of steam engine took about 50 years before these ships actually came to be and create significant impact. So we saw a productivity blip, a small increase when computers and technology came about. It was actually lower than expected. And the productivity has been declining ever since. Anecdotally, I can tell you, this presentation I'm talking about today, we spent significantly more time preparing the layout than creating the content. So the content came about in probably 2-3 hours. The layout took several weeks. In the past, there would be a dedicated person doing this presentation. Now we just all these dedicated people. So technology does not necessarily translate into better productivity. Part of it is just we're all confused. Every time this new Excel version coming out, we need to retrain. There's just that much that humans can absorb. Technology is developing faster than consumers. So technology, artificial intelligence, there are buzz about it. Whether it will create more productivity growth, we don't know. The other point I want to highlight here is the large and persistent trade balances. Again, we know that the United States, the UK, Canada, running a persistent trade deficit. most of the emerging market countries and Germany as well, run a surplus. It creates a way of labor arbitrage when we're shifting productivity into low wage locations. There's less incentive for technology growth. But it's not helpful to productivity. So many factors go into this. What we do know, that productivity is low and declining, and we know that the GDP is not growing as fast. And it has consequences for asset allocation and for your portfolio. So how do we express it in our SA strategic asset allocation? So can we have next slide, please? Again, let's think about the two extremes, the slow growth environment and fast growth environment. So in the slow growth environment, again, think about pre-COVID days. Interest rates tend to be low, so it's less attractiveness of fixed income, and the role of fixed income changes. Again, growth equity will probably benefit more than the value stocks. Private assets will have a tailwind. Again, it's not surprising that private assets performed so well in the past decade. And unfortunately, slow growth environment is more favorable to bubble formation. Think about crypto. And I'm not going to discuss it because it's always a controversial subject, but think about the dot-com bubble. Bubbles come and go. They are not necessarily negative for the economy, but they create a lot of volatility for the portfolio, and it doesn't help the returns. On the flip side of the equation, in the fast growth environment, we can expect interest rates higher. We can expect better performance from equities. We can expect value and small cap stocks to outperform. And in this environment, we expect that the hedge funds will actually deliver better performance and more stable performance. And finally, theme number 3, uncertainty. Okay, the next slide. And okay, can we please have the next slide? Thank you. So we always say that the world feels more uncertain today than before, and maybe there's some psychological bias, but it's actually something we can measure. This World Uncertainty Index, you can go on the internet, you can see it. It's maintained by the IMF. And the World Uncertainty Index almost doubled from the 1990s. So it's real, it's there, and it will continue. And when I think about the radical uncertainty, there are many things that we know about, with so-called known unknowns. So we know that the climate is changing. We know how the climate is transitioning. We do not know, we can make ideas, but ultimately we do not know what will be the impact of this climate transition on the economy and on the markets. Chinese economy developed very strongly in the past 20 years. It started from the low emerging markets, right? It's joined WTO, and now Chinese economy is either number 1 or number 2 economy in the world, depending on how you measure. But it reached a very peculiar point in history, and the Chinese economy is in the process of restructuring. It's not clear how this restructuring will go. As China was developing in the past, used a lot of examples from Japan, from the United States, from Soviet Union. So there are many blueprints for China. There are none at this point. We know that the restructuring of Chinese economy is unknown. We do not know how it will play out. Geopolitics, it's everywhere. Enough said. The role of US dollar in the future monetary system. So US dollar now is a global reserve currency. It's probably the status is somewhat safe for the next 5 years. It's a subject of separate discussion, which we're happy to have, but chances are it will shift at some point. We don't know how, and we do not fully understand the consequences of this shift. Natural resources and access to natural resources. The truth is there are only 2 countries in the world that can be self-sufficient in terms of natural resources. It's the United States and Russia. Every single country in the world needs to secure access. So what's happening in Europe right now, the results of the war, it's been in the news. Europe did well through this winter. They managed to provide enough heating, enough industry. We worry about the next year, the next winter. This winter was very warm, but access to natural resources is a serious concern It will create potential instability in the future. The polarization of national politics, so obviously follow national politics domestically. We know everything about where we stand. The truth is we are not unique. The same is happening globally. It's happening in Brazil, it's happening in France, in Germany, in Italy, Poland. I'm struggling to find a country where it's not happening. Artificial intelligence, it's developing extremely fast. It's a huge unknown. It's something that never existed before. We know it will be transformative. We just don't know how. And ultimately, what measures very close to us, it's the uncertainty about the dynamic between private and public markets. Think about the pre-global financial crisis environment. So private equity was a fairly niche asset class, was developing very fast. Fast forward to today, private equity is about 10% of the domestic markets. It's not a niche class anymore. How the private and public markets will play out in the future, how they will shift, we just don't know. We can make some guesses. But one thing we know, it's an uncertainty. And finally, there's a huge box on the right-hand side of the page, the unknown unknowns. And that's something we need to worry about. Think about 2019, just a few years back. The left-hand side of this page would have been almost the same. The right-hand side would include a war, a major pandemic, and inflation. Nobody could have foreseen it. The future will bring us a lot of unknown unknowns. So why is the world getting more uncertain? Is it an accident or something behind it? So we have the next page, please. And it's actually not an accident. It's a natural evolution of the world. It's partly a reflection of geopolitics. I would say, first of all, the rise of China has a lot to do with this. So again, I mentioned before, China went from being a niche emerging market with a huge number of essentially people living below poverty to a major force. So China is behind a lot of, or rather development of China behind a lot of things that were happening in the world before, starting from inflation, domestic politics, international politics, and it will influence the world going forward. There are tons of unresolved regional conflicts. We don't see them in North America, but if you step to Europe, to the Middle East, to Asia, to Africa, there are a lot of frozen conflicts that may erupt at any point. Again, Russia versus Ukraine is one of the bloodiest, but not, unfortunately, not the only one. Access to key natural resources. I mentioned before, there are only 2 countries self-sufficient, but the demand for natural resources keeps shifting, right? So now we're looking for the rare earth materials. They were not as much in demand just 20 years ago. As technology changes, the demand will shift as well. Oil will probably become less important. Now we're looking more for wind. So we're looking more for like offshore locations. And finally, it's the rising income and wealth inequality. So it's actually, it's a highly destabilizing process. Like if you think about income inequality domestically as wealthy slice population captures more for GDP or GDI, the wealthy has lower propensity to consume. The less wealthy part of the population makes up by borrowing, so you have an increase in debt, you have a reduction in consumption. Altogether, it spells more instability. There are a lot of growing imbalances between the nations. So we're used to the United States running deficit and China running surplus. If you take a step back, it's actually not a natural state of the world. So naturally, we would expect the developed world to run a slight surplus, the developed countries to be a provider of capital for the emerging markets. That's not how the world is functioning right now. It's created instability, creates uncertainty. Global warming, again, it's unfortunately here, it's happening, and it's, I don't say it's a slow moving train. We don't know how fast it's moving. We know it's moving. We don't know how it will come and what the consequences will be. We know it will be bad. Energy transition, again, it's a process difficult to manage. So obviously we want to transition away from oil, but we want to do it in a more managed way, not to kill the economy. Meanwhile, we need to have oil to provide for the industry that will build renewable energy. We cannot turn it off. And again, the impact of artificial intelligence. Hope everybody spent some time with ChatGPT. It's truly transformative technology. I hate to say that it is a source of uncertainty. So what can we do about it? How can we express it in our process, and what's the meaning of this uncertainty for the SAA? There are things we can do. So first of all, we need to be diversified and flexible. Diversification is important. So we don't know which part of the economy and markets will benefit and which parts will suffer. Being diversified and flexible gives us a chance to pick the winners and cut the losers. It's a question of how often we review strategic asset allocations. So this kind of exercise, it's one of the questions we would like to include in the current SAA exercise. Tradition is done every 3 to 5 years. Maybe it needs to be done every year. Maybe it needs to be done every 10 years. But it's one of the levers we have to address the uncertainty and factor it into our process. We may explore broader use of active managers, which give more flexibility to adjust and adapt to the shifting times. We may explore new opportunities through alternative asset class. But alternative, I don't mean just simply private assets. I don't want to say the word crypto because I'm not advocating this by any way. But maybe it's commodities, maybe it's some systematic strategies, maybe it's hedge funds. It's just keeping an open mind and seeing what else is out there and finding the best ways to express the uncertainty. Potentially, it's the ability to express tactical views. Again, I'm not advocating this, but it's one of the levers that we may explore. And finally, what's very important is engage staff and ongoing education. As the world is shifting, we need to stay on top of it. We need to understand what's happening in the markets and what's happening in the economy. So let's bring it all together. So we'll talk about these 3 themes. On the next page, can we have the next page? Thank you. So that's where we bring together all these, starting with the 2 themes, inflation and GDP. So along these 2 dimensions, in horizontal, we have GDP slowing or accelerating, and the vertical dimension is inflation and rates. And that creates 4 macro regimes. In the upper left corner, you see stagflation. So that's where the growth is low and inflation is high. Think about 1980s. That's probably not the environment we want to be in, but it's not impossible. But then again, winners and losers. So in the stagflation environment, what helps? Rates, because rates product, treasuries, investment grade, high yield. Credit in general will probably benefit and provide positive returns. Growth equities, and most importantly, private assets. What will detract? Probably commodities, which is less important for you because we don't have any exposure to commodities. Value equities will probably detract, and value equities is important because a lot of active managers tend to take value deal. It's kind of natural exposure to active managers. Emerging markets will probably underperform, and hedge funds are not expected on average to deliver good returns. In the bottom left, we have stagflation. And that's slow growth and high inflation. Again, I'm sorry, I think I just made a mistake. I called stagnation 1980s. Apologies. Stagflation was the period of 1980s. And probably the only place where you want to be in the stagflation environment is cash and cash-like products. Pretty much everything else will go down. Again, that's not a happy place for many reasons. Where we want to be is the so-called Goldilocks, right? Is the upper right corner. Goldilocks is, think about 1980s. It's the Clinton era. That's the proverbial soft landing that everybody's hoping for, this elusive period where everything is good. You just cannot make a mistake. No matter what you buy, you benefit. Probably the only negative part will be cash exposure, and potentially hedge funds will underperform. So hopefully it will be where we'll end up. And finally, the overdrive, when the growth is accelerating and inflation is running high. And again, there are winners and losers. One thing to understand, the overdrive is probably not a very stable environment, mostly because of the regulatory response. So central bank will probably do its best to kill this environment as soon as possible. And finally, our third theme, the uncertainty. And the point of this third theme is we actually don't know where the world will end up. The uncertainty is that we don't know which one of these 4 quarters will be the next 5 years. As you can see, we need to make an educated guess, which we will between the consultants, BAM, your involvement. But the uncertainty is there. You see that different assets perform differently. And that's unfortunately the world we live in. And I'll stop there, open for any questions.
Thank you. Appreciate it. Anybody have any questions? I think Robin might be out there to opine. Robin?
Hi, everyone.
Hi,
It's nice
Robin.
to,
How are you?
good. It's nice to see everyone.
Great.
And thank you for that presentation. Very interesting and very broad and encompassing. Can you talk, so Ed, you focused very eloquently on the sources of uncertainty and different market regimes and factors that lead to asset class success and failure. But can you, given the radical level of uncertainty that everyone agrees exists, what does that mean for the asset allocation assumption process? And also, even in, I would say, equally interesting to me, at least, is what does that mean for the establishing of objectives for the pension fund? So the pension fund is clearly here for one purpose, which is to meet the benefit commitments that have been made to members. But there are a couple of levers we can pull, which are the level of risk we're willing, expected risk we're willing to tolerate, and our return objectives. You had talked earlier about maximizing the level of return per unit of risk. But I might suggest that first we should think about, given this radical level of uncertainty, are we comfortable with the level of risk we're taking, whether you're defining that as liquidity or volatility? And can you comment about how the board should think about the objectives for the fund and how we're going to establish those objectives in terms of examining the level of risk and liquidity that we can target over the next 5 years or so?
Robin, it's Steve Meyer, if I can jump in. So this has really just been a thought-provoking exercise. It's really the types of things we think we should be incorporating into our thinking in terms of being long-term investors. Part of this is to engage with the general consultants to see how they think about these things. And do they incorporate some of these items into their forward-looking capital market assumptions? Again, it's, I think Ed very appropriately talked about the fact that a lot of these assumptions are backward-looking. And I know there's some quantitative processes that are put in place in terms of trying to have them be more forward-looking. But I think the question we raise is the last 25 years really the best time frame to look at in order to base your forward assumptions on, and that there are a number of things in the markets that are really fundamentally changing how we look and think about things and the risks associated. So those are all good questions. I mean, those are the types of questions, is why we shared it with Rokitan, Goldman Sachs, and other general consultants. Is how do you guys think about these? How do we think about? Is there a better way to incorporate these longer term themes into that strategic asset allocation process? I'd like to answer very clearly right now these questions. I don't know. I don't think anyone knows, again, given the level of uncertainty, but I do think these are things that we should be thinking about. And I think when Ed talked about the process going forward, about strategic asset allocation, about potentially providing more flexibility, tactical views, again, not advocating a position, but are these the things we should be thinking about, again, in consultation with yourselves, as well as certainly the trustees, is, how do we be more flexible around these levels of uncertainty? So, I mean, I don't mean to to push it back to you, but I mean, it's more of a process of evaluating alternatives going forward, versus having some concrete, these are the three things that we think we should be thinking about, and this is how we think it spills out into capital market assumptions.
And so agreed with all of that. There is no crystal ball. And while we've always, and I know the other consultants too, try to think forward and not rely too much on history, although history provides some interesting information. I guess the question that pops out at me, given the level of uncertainty and the unknowns, is should we be thinking differently about the level of risk that the fund is going to take over the next 5 years? And I'm not prejudging whether the answer to that is yes or no, but uncertainty equals risk, right? And so does that mean that we want to think differently about the level of risk that this fund will target? This, because we have a fairly high level of equity risk in the portfolio, right?
Excellent point. Yeah, I agree. And I'm not pre-gaming or prejudging the outcome, but I think Robin, that's an excellent question to ask, and when we think we need to put our heads in favor in terms of answering.
Great. Thank you.
I mean, this is, Robin, this is also just something that we, as pension managers and as consultants, we go through this process where everyone kind of follows the same assumption. We have capital market assumptions, they're backward looking. We massage them a little bit from the quantitative techniques to be a little more forward looking. We may try to incorporate some level of expectations. But as you know, any forecast any forecast is going to be wrong. And any forecast that's 10 years is going to be really subject to a wider degree of potential inaccuracy. So I think it's a challenge upon us to really think, is there a better way to do this? And are there other things we should be thinking about? I think the question around risk, flexibility, tactical decision-making around these, I think those are all things that we should be talking about with the trustees and with each other.
Great, thank you.
Steve, it's Tom. I'm sure we'll be discussing going forward the impact of the fossil fuel divestment that we did. That will be in the discussions.
Mm-hmm.
What impacts?
Absolutely, the impact on the portfolio. We look at tracking error. We can look at expectations for that energy transition that Ed talked about. Listen, and I don't mean to make a judgment whether it's wise, divestment is wise or not. But I do think Ed's point around we're going to need to rely on fossil fuels throughout the transition. And I personally believe the transition is important and it's something we need to focus on. But I believe it's going to take longer than a lot of people expect. And I do think that we're going to have to continue to use fossil fuels to help build up those alternative sources of energy. And maybe that's a transition away from oil into natural gas and into something that's greener. I really believe it's something we need to focus on, but I think it's going to be a challenging road ahead. Some of the other aspects of fossil fuels and climate change, Tom, also reflect around, availability of water scarcity, food scarcity, immigration, migration out of areas that may become uninhabitable based on the heat and dryness. So there's a whole bunch of things that I think we should be thinking about without clarity. Robin's point's, very good. Good one. There's a lot of uncertainty out there. And I don't mean to just pitch more questions at this. But I do think it requires some thought. And now's a great time to be thinking about these issues.
Thanks, Steve. I think David Kozansky has a question.
So I think building on something that Robin mentioned and kind of was one of the big themes around uncertainty and how much history really is of any use going forward, right? Because it really feels to me that, especially since COVID, or maybe just because of COVID, I'm more hypersensitive to it. But it really feels as though everyone continuously seems to be surprised at the way things are happening. More so than maybe 5 years ago or 10 years ago, where it felt like there was a more, oh, this is probably going to happen, and people patting themselves on the back that they were right. It feels like there's less of that now. So how much of I mean, how much of a balance are we trying to set between the uncertainty of what's about to come and the fact that history may not be as helpful in understanding how to navigate that uncertainty as it used to be?
And David, to your point, I think the world has changed obviously very dramatically since 1918, which is the last time we had, we've had wars in the past, we've had inflationary periods in the past. This is kind of unique where we're coming out of a global pandemic. At the same time, we have a war in Europe and high inflation pretty much around the world. So it does seem as though that now is, listen, the hair on the back of my neck bristles when people say it's different this time, because it usually isn't. But it just feels as though we're at an inflection point, and maybe it's coming off of a 40-year secular decline in rates, bottoming out in zero level of interest rates, which have caused some excesses to build up into the financial system and asset prices. I'll ask Robin to weigh in as well as Ed to that question. But I mean, that's a really good question, and it feels, I've been doing this for almost 40 years now. It just does feel like we're at an inflection point. Not to say it's different this time, it just feels like it's changing.
If I may add something to this, so you're absolutely right. It's the world is uncertain, it's not clear. That said, in terms of market information, we typically can go back about 20 years. And it's simply because a lot of stocks that currently exist were not even issued, were not IPO'd back then, right? So we can use this period, and if we use it carefully, we can actually find the periods of inflation, deflation, slow growth, fast growth, definitely crises. So it's plenty of information. You need to use it carefully. In terms of economics, understanding the economy in general, we can go to the mid-19th century. We have reliable data. It provides a lot of guideposts and understanding. The biggest wild card is actually the central bank, because the central bank learns from the past, and every time the response, not just the Federal Reserve, but also central banks, the response will be different every time. So the past crises are part of the policy, part of the regulation, and that's what keeps changing the world. So I think the answer to the question is yes, we can use history as a guidepost. We cannot use it blindly. We need to go very carefully. But there's plenty of information. The other point I want to make is I would take any systematic process over anything discretionary, right? So as long as you apply the same rule over and over again in a consistent way, as long as you have a solid process, chances are you'll come ahead. And that's the whole point of why we're doing this, strategic asset allocation. So we argue on fringes, and we will, about whether private equity needs to be 8% or 7.5%. I just make up numbers. But it's important that we're having this conversation, important that we argue, important that we go through this process, because fundamentally, it's the same process. We're just trying to make it better. And to me, that's the key to addressing the uncertainty, to have a firm, systematic process that stays through the time.
Great. And another question, or not a question so much as something to think about when we're doing asset allocation, is around the concept of active management, right? And I believe one of your slides said that we want to take advantage of broader use of active management. And I don't know, it seems to me that active management, generally speaking, and I apologize to anyone who is an active manager who's listening, right? Either doesn't do great or really doesn't do great. Like, it doesn't feel as though in this modern era that the advantage of being an active manager, especially in the bigger sectors, right, where so much information is available, that really active management doesn't seem to be paying off the way it used to. So I just kind of want some really thoughtful assistance on whether or not active management is really going to pay off for us in this upcoming allocation.
Absolutely. And my point on active management, I was not advocating for active management. My point was it's one of the considerations we need to think about, right? So There's a potential for active management to address this uncertainty, but potential doesn't mean that it will, right? And yes, you're absolutely right that active management as a group underperforms strongly the markets. That's obviously better managers perform better. I would like to bring up another question to the mix. It's not just active or passive, but also how many active managers. So there's
Yes.
two dimensions to the problem.
Right.
And it's definitely one of the questions we're looking at, and we've been talking internally with Steve and the rest of the team about the role of active management. I think it's one of the questions we need to address as part of this exercise.
I'll ask Robin to weigh in as well, but I agree. I don't think there's a foregone conclusion, Dave, that active management is necessarily delivering the returns you expect consistently. To the contrary, I do think that's part of the assessment we should go through is our asset in our asset allocation process is the active passive mix. But Robin, what are your thoughts?
My thoughts are aligned with those of David's. This board has been inclined, where possible, to use primarily passive management in large publicly traded asset classes. And there are certain large asset classes, maybe, some fixed income, for example, where the fees are low, and there could be arguments that certain asset managers have information advantages. But I think this board has had a healthy skepticism about active management, and I think that's served it well.
I share that skepticism.
Thank you, Rob. I think Anthony Giordano has a question.
Yeah, I really enjoyed the presentation, and it seems like that 25-year mark is kind of what everyone's targeting, because I think it was 22 years ago, it was the last time the stock and bond markets were correlated in a downward spike. So it seems to be interesting. I follow a macro research provider on a daily basis that kind of calculates. So I have two questions within the context of the presentation. I follow this firm. They do 150 data points every day, but their key element they look at is volatility and rate of GDP growth or decline. That seems to be their key indicators. So I was curious about how you guys look at that within the context of your macro assumptions. And then as I've been looking at their data, and they've been on point in terms of predicting, but how does that, as a pension fund trustee, how do you translate that data, which they've been on point, pretty calling all the dips, calling up and down, but how does that correlate to long-term investing in terms of the overall asset allocation process? I mean, we could risk on, risk off a little bit, but on the whole, shouldn't we kind of have a longer plan than what's going to happen in the in the next year?
No, I completely agree with you. It's all about the time scale.
Right.
So in the long run, the medium run, it all washes out. I mean, the truth is that volatility tends to stand fairly low in the market. So we now fixed income volatility, it's some exorbitant level similar to 2008. It will probably not stay at this level for very long. The truth is, if you look at the VIX, which is a measure of equity volatility, it typically runs below 20, like 80% of the time, right? So over the long period of times, high volatility usually correlates with market sell-offs. They usually revert, and usually a problem that corrects itself, right? I'm sorry, I'm not familiar with which macro you're following.
I'm not giving anyone plugs. So.
Right, no, but it's actually fairly unusual for macro forecasts to be based on volatility, which is volatility, just how fast things change. Usually macro concerned more with so-called tail risks, which is extreme sell-offs. They correlate with volatility, but not necessarily the same. But the GDP growth is definitely one of the main wildcards. And that's the foundation of everything, right? And that's a big gorilla in the room, right?
Hey,
We also
If
try
I
to
could-
maintain a long-term investment horizon, Anthony, in terms of how we think things, and the indicators you talked about are looking at 1 year. Good question. And the real issue is around the ability to make tactical trades. We don't do that now. We strictly adhere to the targets that are given us. If there was a decision made by the Board of Trustees that you'd want us to start being more tactical in that allocation process and have decisions or positioning inside of, say, a 12-month horizon at the margin, we could do that. we're not set up for that now. I agree with Ed. I think it would require a systematic and probably a quantitative approach. But within the Bureau of Asset Management, we're not actively in the market. We're not underwriting new deals. We're not looking at daily flows into and out of bond and stock markets the way that, say, other players would be that are actively managing assets in-house. So we would need to really think about how we could possibly represent those tactical bets in the portfolio in a strategic, systematic way. But as I said, it's food. It's certainly something to discuss and think about, but it's something we're not set up for at this point. I'm sorry, Robin, I didn't mean to speak over you.
No, thank you. Yeah, I think expressing tactical views is is an art that's been successfully done by a very limited number of players, and those people are set up exclusively to do that and structured in a completely different way. It would be quite a governance and change to be able to incorporate tactical views. But I go back to the last thing I want to say, and I don't want to be redundant, but I go back to the fact that we can't predict returns. We can't predict the economic regime we're going to be moving into. We can't predict macro shocks and macro political events. So what can we focus on? We can focus on the kinds of risks that we're willing to take. We have to take risks to generate return. We have to generate return to grow the assets to meet benefit commitments. We can't rely exclusively on contributions. And so therefore, I think the decision we're looking at is what kind of risks we're willing to take and how much of those risks. And that's difficult to predict. But if you look backward at history, risk volatility is a much more consistent over multi-year timeframes, is a much more consistent statistic than return, infinitely more consistent. So given that we can't predict returns because we don't know what regime we're going to be in, I would say we should be focusing on the kind of and level of risks that we're willing to take to generate the necessary return for the fund. And we're not return maximizers. We're just not. Because we're not a hedge fund. We are a pension fund in which very volatile returns have a big impact on contributions, and so and ultimately on members. And so I would suggest that the board should be really focusing on the kinds of and levels of risk, which is a much more intangible notion. That's why people like to focus on returns, because everyone understands return, and risk is a much less intuitive and less tangible notion than return. But that's the decision we're going to make in this asset allocation. What risks are we willing to take?
That makes sense. And I agree with your comments around tactical decision. It can be done. It's very rare and it tends to be inconsistent. And there's a price tag that is associated with being able to build up those capabilities. Assuming you can get the look into the flows.
Thank you. Allison Hirsch has a question.
Yeah, I just want to go back to the active passive conversation for a minute, because there are obviously benefits to being passive, lower fees and all that stuff, all that. And I just wonder what the cost benefit analysis is from a fiduciary perspective with, we can't, invest in as many like emerging managers if we're entirely passive, and often emerging managers, we've seen like smaller managers get higher returns than some of the bigger folks, and so I don't know, like, what is the, maybe this is just a question that can't be answered today, but as part of this process, like, what is the balance, like the appropriate balance, I guess, between passive and active, thinking about the other like sort of fiduciary interests and goals that we have as a board?
I would say, Al, that's a great point. I think it probably won't be answered today, but I think those are the issues that we're wrestling with. I also think that it's not a passive active. It's not a binary decision necessarily based on the entire allocation. It's more specific to markets where we think there might be an advantage that we can earn through better information, less market efficiency. So I think it's nuanced when you look across a large cap equity versus small cap ex-US or emerging markets. It's not to say that there aren't capabilities to invest in a passive strategy across all assets. But to get back to Robin's point, it's really about the risk relative to the expected return. And is there an expectation you'll be able to outperform through an active allocation in certain areas? Like I said, I don't think it's meant to be a blanket statement, although I know one or two large pension plans out there have taken that decision to go all passive in public markets and really try to differentiate their return stream through active selection of investment managers and private assets. But like I said, I think that requires a lot more thought and discussion, but great question.
Great, thank you, Steve. Any other questions? Thank you, Ed, for that presentation. Next on the agenda is the resolution to approve the net zero by 2040 implementation plan. Do we agree we'll defer this reso to when we come back into public session?
Yeah.
Yep, great. So do I hear a motion to go into executive session? So moved. It's been moved. Do I hear a second? Thank you. And it's been seconded. Thank you. Any discussion? All those in favor say aye.
Aye.
Those opposed say nay. Any abstentions? We're now in executive session. So we are back into public session. So teacher members have decided to lay over the resolution.
And just for the record, you're referring to item number 2 on the public agenda
Item number,
for the pension fund.
correct. Okay, and then we have a readout.
Thanks, Tom. In executive session of the passport funds, there was one manager update. In executive session of the pension fund, we received preliminary performance data. We received 2 private equity presentations. Consensus was reached on both. And there was a discussion on an investment policy issue, and further discussion was laid over.
Thank you. Do I hear a motion to adjourn?
So moved.
Second,
Second.
all those in favor say aye.
Aye.
All those opposed say nay. Any discussion? We are adjourned. And there is going to be an attorney-client session. Thank you.